and me, we should try and get from our guest today as to what to do as we approach the weekend after having 2 strong days.
Not
frankly.
to do much on the weekend, I would
Maybe
say.
that too.
And get a drink would be advisable.
But right now, for the next
today,
8 hours.
You mean today. We've got to still keep the focus. It is still
Yes.
Friday. We do still have a day ahead. But the good news is, the fact remains that earnings is pretty much behind us. Focus is going to be back on macro cues, global cues, and of course, all eyes will now be on the political setup. A quick check on the implied Nifty. It's looking like another strong day, and that's good news coming in for the street. Opening around 22,000 is what we're looking at in early trade. A quick check on what happened across the world. Asian markets are having quite the field day. Japan has chosen to ignore the fact that it's in a technical recession and is actually gaining in trade this morning. Bulls, of course, looking at the brighter side of things, they believe that if Japan continues to remain in a recession, the ultra-loose monetary policy will be a big boost coming in for equity markets, and that explains why you're seeing Japan in the green this morning. It's off the day's high point, but still looks actually pretty good. Apart from that, China continues to remain shut, so they continue to be in celebration. Nothing much happening across those markets. The rest of Asia as well, not doing too badly as we see it. Well, Wall Street as well clawed back its losses from the first half of this week. Remember, inflation data came in higher than expected in the US, which means that the rate cuts have been pushed down the road. But this morning, or rather last night, retail inflation data came in lower than expected, which also means that while inflation is a worry, spending in the US is also looking slower. So you've got 2 opposing data points, and that will be, of course, the key triggers in terms of what the bears and the bulls do. Just like Japan, you also have US investors who are cheering the fact that lower spends or lower retail inflation could potentially encourage the Fed to come across with those rate cuts despite higher inflation numbers. So mixed cues there, but decent earnings as well on Wall Street. The focus will again be back to what happens in the macros. You've got some more data out of the US later today, and that's largely what it is. But interestingly, it was another record close of the S&P 500 on the same week that the Dow saw its biggest fall in over a year, reacting to inflation. So lots of records, and these records happen so frequently these days, especially for global equity markets, right?
But I wonder, Samina, if indeed what you just said is probably the key factor, that if indeed economic data the world over is looking sketchy, and in India too, there are points to ponder, and we'll come to that. But does that spur the Fed to do something which in the commentary thus far is not coming out?
I mean, it's a tough job if you're the Fed chief. What data do you pick? And you're also going to elections in the US. Let's not forget that, right? I mean, it'd be interesting to see how historically the Fed has behaved during election time when it comes to rate decisions. But so those are the cues. You had the bond yield fall actually quite sharply on back of that in retail spend data. The dollar remains around 104.25. Bitcoin's been in a sweet spot, so sustaining bar levels of 51,000, and that is significant. So you've got other asset classes that aren't doing too badly, and so are equities. Equities have been in a pretty good space despite everything.
Yeah, and sorry, just before the trade setup, since you mentioned Bitcoin, I was reading the Greed and Fear note this morning. I think Chris Wood and team are allocating 10% of the Greed and Fear portfolio, unless I'm very wrong, 10% of the Greed and Fear portfolio to Bitcoin. So, you know, it's making its presence felt in 2024.
And it's done its time, right? It's spent the last few years being debated, and now finally with its launch on the exchanges is a huge sort of sign of regulation giving it a thumbs up. But Niraj, what are we gearing up to? Implied Nifty is looking good. I'm hoping we're reacting to these global cues, and we'll stay with that. It is finally Friday, which I guess, and we've had a pretty hectic week.
Very hectic week. And you know, the technicals for the last 2 days, viewers, have kind of shown a bit of the hand of the market. So if you just look at the Nifty behavior, just the Nifty, okay? And remember, viewers, I mean, to a credit on trade setup, we spoke about it for the last 3-4 days that the quant indicators were indicating that the 21,500 level was a level that was very difficult to break. We haven't done that. And for the last 2 days, Nifty's been forming higher highs and higher lows. So in technical parlance, that's the limited technical understanding that at least I have. I don't know if Samina has more, but that is an indication, or that is a pattern that a lot of people follow. But when you look at the options data, which is maybe from a data perspective a lot more easy to decipher, right? Just look at the put versus call writing. not at the lower strikes, but at 22,000 or 20,100, you've seen a significantly higher put writing versus call writing. Now, typically call writing being higher at the higher levels adds a bit of a cap to those upsides, right? Now you're seeing put writing happening there. Are people confident that in the current expiry, the index will actually head higher based on what's happened in the last 2 days? So I think that's the question that you've got to monitor. On the index perspective, that seems to be the key thing. Plus the global markets doing what they are, the implied open suggesting what it is. Very likely that the put writers will actually have their day in the sun. Maybe the call writers won't. And from a sector perspective, frankly, yesterday was a return of the PSUs, if you will, was a bit of a damp day for FMCG. But the second rung oil and gas stocks rally is now well and truly underway. But I think I spoke to some smart money who said that, one, there is no news. Two, the upsides for the second rung players, which are playing a valuation catch-up, might be capped. There is a very large upgrade on BPCL, which we'll come to as well. But that is the thing. But, Samina, the point to ponder from a consumption perspective, and yesterday, other index which stood out very starkly was FMCG, right? We saw everything from an HUL to Britannia to ITC being in the red yesterday. There is a question to ask based on macro data. That is a consumption slowdown underway. The non-oil, non-gold imports, which is arguably the second best indicator of consumption, down 11%. And a few days ago, we saw the inflation data showing core inflation at 3.7, which is the lowest reading in almost first sub 4% reading in almost 4 years.
Yeah.
Are we looking at a consumption slowdown? Could it hurt specific pockets? But are we looking at that in India as well? We've been talking about UK, Japan hitting those recession. Are we staring at some consumption issues in India?
My only point, Niraj, on that is while we agree that there could potentially be a slowdown coming away, the GDP numbers have not been revised downward, A. B, we've seen some of those earnings. While the rural consumption story may be showing some signs of, or may not yet be showing signs of a pickup, you've been talking to Pranjal and you indicated that while we might be now beginning to see some sort of green shoots coming from rural consumption, urban consumption continues to look good. Now, where this money is going is anybody's guess. Maybe spending in consumption is coming off, but buying assets, buying equity, buying real estate, those have been on the uptick, right? So maybe you're not going and buying clothes and new shoes, but you're buying new stock.
Which is great news, by the way.
Which could be. I mean, look at those numbers that we're seeing in terms of additions of SIPs month on month.
So maybe capex plus investment, which is good for the economy, yes. So the economy numbers, which is why RBI has probably kept it at 7%. But consumers.
And I can't disagree with you because there is nothing like decoupling, right? We talked about this a decade ago. The fact is we are tied to the world, and if the rest of the world is seeing slowdown, we may not decline as substantially, but the weakness will be felt back home as well. You talked about valuation, and what was also interesting was the move HDFC Bank finally made. In overnight trade as well, there was some sort of excitement. The stock rallied up, taking a cue from what happened in India, and finally, came to the rescue of the markets for a change in trade. Also, an interesting piece that I saw, Niraj, and you can add on this. Within the last 1 year, HDFC's ownership on the index exactly a year ago was 15%. It's now come down to 10%. Reliance Industries was, I believe, 10% a year ago, now stands at 11%. So is there a new leader? That's the big question we will want to understand and ask. We'll try and see whether these are just interim movements or whether this means more than what catches the eye for now. But we moved away from earnings season, so not too much in terms of earnings reaction. Still a few stocks that we'll be watching out for in today's day of trade. Unfortunately, bad news again, topping my list is UPL this morning. It just doesn't seem to stop. Weak numbers, brokerages downgrading the stock, and now it is the Fitch ratings that has downgraded UPL. Long-term issue default rating to BB plus from BBB minus. They've said that the last 9 months have actually been really weak for the sector, and they expect demand to continue to remain soft. And they also see that demand will continue to remain soft due to the prolonged destocking and production overcapacity, which will keep demand negative. So that is, of course, UPL. We may potentially see a reaction to this. But remember, the larger markets are buoyant. The stocks also corrected quite sharply. So maybe not a very bad reaction in terms of stock play this morning. Dilip Bilkon was quite the trade over the last few days. They reported earnings, remember, 2 days ago. The stock didn't do much yesterday, but the day before that saw a very sharp rally. They've been declared L1 bidder for a tender that was floated by the Water Resources Department in Madhya Pradesh. This joint venture in this irrigation project is to the tune of 412 crores. The Lip Bilcon could be seen reacting to their news this morning. Another last earnings that we have EPAC Durable. They reported a profit of 4.9 crores versus a loss of 6.25 crores last year. Revenue has grown about 1%. EBITDA is up 454% to come in at 23 crores. And margins also expanded substantially at 8.5% versus 1.4%. So those are a few stocks that are on my radar. But talking about block deals, Niraj, I think the big one to discuss this morning is Yes Bank and Carlyle's reducing its stake. The fact that they came in a year ago claiming that they're backing the bank, but with a 28% run up, they've actually managed to liquidate a little bit of their stake. And of course, Morgan Stanley's come in and picked it up.
Yeah, and nothing wrong. I mean, taking some chips off the table at a point of time when we're looking at some credit tightening or the NIMs tightening happening for private banks by and large. That is one. But actually, speaking of block deals, the other one to focus on could also be Sudarshan Chemicals. We've been talking about this one yesterday, and chemical stocks finally seeing some bit of buying because it's a sector that's been ignored for maybe multiple quarters now, 2, 3, 4 years. But HDFC Mutual Fund has bought about 17.75 lakh shares, which is 2.5% equity in the company at 514 rupees or thereabouts. So do watch out for this one. Had a big bump up yesterday. Maybe could be more in store. You know, the list that I have is largely, I'm standing on the crutches of the brokerages this morning, but there are some interesting ones there. So BPCL had a big mammoth uptick yesterday. Jefferies has this large upgrade on BPCL. They are saying they've upgraded the stock to a buy with a price target of 890 for a BPCL from 652 current price. That's our 662 or thereabouts. So that's a significantly large upside left there. They say the Red Sea disturbances have strengthened the refining margins. The current marketing loss on diesel could be transitory is the other point that they are making. So that's the piece that because they believe that OMCs could hike their prices post-elections effectively. And they believe that BPCL offers the largest margin of safety if the multiples for oil marketing companies largely go back to the Goldilocks scenario that used to exist, and which is why Samina, this 2.8 times forward price to book on the target price. The only fly in the ointment is while they are harping upon this government's not being interfering off late, could there be a price cut that could come in ahead of elections? Could well be anticipated, and could that spoil the party?
Yeah, I mean, talking about a party, that space has not just been buoyant yesterday, Niraj, but even the day before that. BPCL was up 7%, so the compounded gains on some of these counters is shocking. And you know what surprises me is, or at least in the recent past, what we've seen is if it's a good day for the OMCs, it's a bad day for the downstream, right? Upstream, downstream move into opposite directions.
Yesterday was different.
So was day before yesterday. So while you had an Oil India, ONGC gaining, you also had BPCL and HPCL gaining in the same amount of quantum. We've got Probal Sen joining us in a few minutes, so we'll understand from them what's happening. Is it? I mean, I couldn't attribute it to higher crude prices because that would mean bad news for downstream. We couldn't attribute it to lower crude prices because that also would not work well for downstream. But nevertheless, you want to come in on a few more stocks?
Yeah. The other one, Samina, is aviation. Much as we're talking about growth factors looking strong, look at what Jefferies has said on aviation stocks. Domestic air passenger traffic growth continues to slow down. It moderated to about 5% growth YOY in Jain, which is the slowest growth since COVID. So that's part one. Indigo's market share. Talking about investment implications, Indigo's market share slipped to 60.2% in January, which is the lowest since Go First shutdown in May 2023. So there are some issues for Indigo. The drop in the share could well be the impact of the aircraft grounding in Q4, or frankly, the erratic scheduling that's happening, or the delays that are happening as well. And social media is agog with all things around Interglobe Aviation. But these are ramifications for both airlines like Indigo, as well as take a moment back for GMR Airports, which has had a spectacular rally, but could lower passenger traffic growth result in lower footfalls for airport revenue. So I think that's the other piece to keep in mind, because remember, since the time GQG invested, GMR has had nearly a 50% rally from 60 to 90 in a spate of less than 2 months or thereabouts. So that's to be kept in mind. Sorry, you want to add to this?
You're talking about aviation, right? I mean, I'm sort of trying to rationalize why you would see a decline, because I don't think travel has come off that sharply.
Growth is slowed down.
But could be a few reasons. Railway travel has potentially picked up. I mean, we saw what happened in, when the match was happening, right? When there was, of course, the IPLs or the World Cup finals.
World Cup finals.
Most people used the train because you couldn't get hold of tickets. Secondly, you've also had bad travel conditions in terms of congestion. You also, only a few days ago in Mumbai, putting restrictions which led to flight cancellation. So I think all those things could have weighed in on why those numbers look weaker. I don't think it's or maybe, like I keep saying, discretionary spend is coming off and everyone's gotten wiser and smarter and putting the money in equities. But that's on a lighter note.
That's on a lighter note, yeah. But, and sorry, just one last piece here. Air India has actually strengthened its market share at a point of time when Indigo has lost. So, Vistara
and those flights have gotten really good, is what I've been told.
Yes,
I haven't flown in Air India.
No, our CEO flies 3 days a week. He's been harping about Vistara.
Are you flying to Singapore on Air India?
Air India, yes,
there you
indeed.
Go. And so that's Air India. Just another, go on.
Well, one last one, sorry, is Citi note on NMDC. Downgrade to a sell, target price raised to 215. They say that the domestic price at export parity currently, and therefore little volume upside, price upside and little volume upside beyond FY25. They say that the medium-term balances imply modest surplus market, likely resulting in a price correction. Even if they've upgraded the target price, it's a sell. It's a downgrade, and it's a downgrade to a sell because the valuations are one standard deviation above the long-term mean.
Just one quick one before we cut to editor's cut is a new listing. We don't, of course, we will just quickly mention that. We've got more on it during the day. Entero Healthcare, they are a healthcare product distributor. They will be debuting on the exchanges later today. The final issue price has been fixed at $12.58 per share. We'll have some more details over the premium currently is that and what sort of an expected listing is there. But that's the quick last update I have. Niraj, back to you.
No, so, it's time for editor's cut. And
high time.
And we are truly digital, Samina, because somebody requested us, or rather spoke about us in a tweet, that why don't we do an earnings review of sorts on the 16th. Now, we can't do the whole thing, but I'd love to ask Agam. I'm a part of this, of course, but I'd like to ask Agam that, Agam, it's great that Aniket asked us to do this, and we are picking up specific pockets of earnings to be discussed in the session today.
Yeah, 100%. And so not only are we looking at how the quarter's gone by, but we're looking at FY25 upgrades, downgrades. We're also talking about two sectors specifically which stand out, and that is the auto sector in terms of how it's done, as well as what we can expect from the banking space, because a lot of divergence, a lot of volatility has come through as well. But Niraj, let's start with the quarter gone by and your observations here.
Yeah, so some things that I've picked up, and both of you feel free to come in on this. So rural weakness seemingly has not gone away because the staple companies have sounded off a mixed bag. Very few actually sounded very confident about both volume growth and margin growth. So that was the first takeaway. And I think we saw that in the FMCG counters yesterday as well. All four were in the red. I'm not saying that's necessarily the reason, but that was one. Construction activity likely to be soft unto elections. So construction companies have sounded it off. Equipment companies have sounded that off. But cement companies haven't. Now, could it be because of housing demand? So that's the other piece. But because cement has sounded like the lone star of confidence, if you will. Yes. Bulk deposit pricing, and Harsh might have a better insight, but bulk deposit pricing inching up for banks. Could it impact Q4 as well, and could it impact FY25? So I think, Harsh, both me and Agam would ask you about this when you come in with your piece on lenders. So that's part 3. Automobile demand has been stable, save for tractors and maybe some commercial vehicle segments, not all, but SUVs and PVs, SUVs in particular, rocking really. M&M's commentary out there. And lastly, tech companies, and Agam would have a great insight here, but tech companies continue to see uncertainty on discretionary demand, and therefore difficult to say if there is a pickup in store or not. So that was in a nutshell before we get to sectors, and and maybe just before Harsh talks about banks, and then I'll follow up with automobiles. But just before that, when I looked at the key upgrades and key downgrades numbers, I don't have them rounded off until Feb 14th, if you will, but slightly earlier. But amongst the key brokerages and the key upgrades and downgrades that came in for earnings, Cipla, Dr. Reddy's, HCL Tech, Sun Pharma and Adani Ports were the ones which saw significant earnings estimate upgrades for FY25 on the back of this. So pharma ruling the roost in that fashion. And I'm sure there are more, but pharma came out smelling very well. And earnings downgrades, well, ITC, HUL, so FMCG, LTI Mindtree, so IT, and Axis and IndusInd Bank, so banks. So that largely construed the earnings downgrades. And I'm sure there are more, as I said. But in a nutshell, if we had to point out the large ones on the Nifty, at least these ones were it. So, you know, Aniket and others who asked us about forward-looking things, this seems to be the overarching picture. And Agam, that is it from the larger perspective. Now, maybe we can get into specifics.
So, you know, pharma was certainly a very quiet mover. The earnings came through very quietly and they were very strong. It's not just the frontline names, even the mid-cap pharma names have shown tremendous growth, not only on the top line, but the bottom line as well. IT to a certain extent, of course, was expected. But, you know, there were companies like LTI Mindtree, which were trading at such high valuations. And they were expected to give you a growth of around 15%, 20% on a year-on-year basis. And that perhaps now, and with the benefit of hindsight, does look like a bit of a stretch. Of course, that really didn't come through. And ITC and HUL, the FMCG pack, that's where the weakness does subsist. A lot of that is still on account of weakness in the rural areas. So fair enough. That's the observation. But banks, of course, Harsh, that's the big one here.
Yeah, absolutely. So I'm going to try and cover all of lenders, if I may. I'll start off with some key trends which are playing out in the lending space, especially in this quarter. As has been a spillover of the last quarter, deposit growth has been in focus even in this quarter. And therefore, there's been a focus largely on margins because the impact on that has started to come through. We saw both private as well as public sector banks showcase how margins are on the decline. Some of the surprises came in from the public sector banks because your loan to deposit ratio over there is quite strong. No need to dilute margins, but nonetheless, margins have come off, which is one big observation from a PSU bank perspective. But lots of positives within that PSU bank space. Earnings growth continues to be quite robust on the back of benign credit cost. OPEX continues to be on the rise, but OPEX on the rise is largely because of wage provisioning, so it's going to be temporary where the PSU banks are concerned. On the private banking side, OPEX is higher largely because they are growing from a geographic reach perspective, adding employees, and that is expected to taper going forward. But how much forward we're looking at in terms of the taper, not really sure. But in Q3, the trend seems to be OPEX seems to be playing out in a strong fashion, even within the private banking side. Where are concerns? Well, there were some concerns with regard to unsecured lending. That particular piece continues to be a piece of the puzzle which isn't fully solved yet because growth continues to remain quite robust over there. Companies still looking for growth, most companies still looking for growth, most lenders. But at the same time, there is some bit of concern with regard to rural B2C, where Bajaj Finance came out and suggested that there is some amount of delinquency and some amount of stress there.
And if BAF is saying people should take notice
Yes,
of it.
people should take cognizance of it. And they've been saying it in the last 2-3 quarters. It's not new. But that's where it is. But growth continues to remain robust. Someone like a Kotak came out and said we'll still continue to do unsecured in a big way. They've grown unsecured mix from 7% just maybe 4 quarters back to 11.5 now to 15. And that is supporting margins. So a lot of these trends kind of playing out. Profit continues to be solid in terms of the overall lending space.
What about specifics?
So maybe I can move to specifics. Let me start off first with the largest lender, SBI. Margins declined surprisingly. We did mention about the loan to deposit. The other piece is that Q3 was dominated by one-offs. They put it out there saying that this is lots of one-offs in this quarter. Q4 will have around a 5,000 crore expense one-off as well. So that's something to look forward to. The lending pipeline is very strong for SBI, and the loan to deposit ratio is probably best in class at the moment, given the kind of the kind of structural issues we've seen with regard to deposit growth, it's probably the best. I'll quickly move on to the second largest, HDFC. Deposit growth is weaker than loan growth. What they are suggesting is deposit rates for them as a strategy is not going to be deposit rates which is going to drive deposit growth.
Sure.
They believe more reach, more premium services is what is going to drive growth. And they believe that the deposit repricing is still to be done for the next 1 to 2 quarters from an industry perspective. So they're expecting deposit repricing to happen over the next 1 to 2 quarters more. Which is where pain may be expected going forward.
Some pain.
Yes,
okay,
on the deposit side. Second is customer spending once it falls, maybe that will aid deposit growth. And third, new customer relationships is what will drive deposit growth. The surprise with regard to guidance was they tapered down their branch guidance from 1,500 to 1,000 for FY24.
Okay.
So how are they going to reach more customers? That's a concern, at least the way I look at it. ICICI Bank, third largest lender, does not expect credit costs to rise, continues to hold around 13,000 crore of buffer provision slippages. Buffer provisions. Slippages are in retail, B2B and rural. Those are the ones which have increased. I'll quickly move on to Kotak. NIMs have remained flat, low base of course, but flat nonetheless, which is a big positive. They expect deposit rates to go up. Their product called Active Money and has grown very, very well, and those balances are aiding margins is what they suggested.
Sure.
Unsecured, we spoke about how they're going to take it to 15%. And very, very lastly, Bajaj Finance, one on the NBFC side of things, they've indicated stress in rural B2C. They're calibrating loan growth in rural B2C, brought it down from 26 to 10% on a year-on-year basis. They are expecting cost of funds to move up, so that's another big negative. Risk metrics outside of rural B2C are in good shape is what they suggest, and loan losses are normalizing. So they are saying that they'll slowly start to trend upwards. That is normalized.
Sure. So plenty to take forward when it comes to the lenders in general, and of course that divergence when we consider the private sector banking space against the public sectors, as well as NBFCs, and of course Bajaj Finance has seen its own share of challenges. But Niraj, it does seem like the lumpiness in volumes growth for autos is behind us.
You could argue, and I know people, I'll make this quick because I know people are waiting for that FNO segment. So I'll make this very quick, Agam. But yes, you put it well, because I asked this to Anisha as well. Was it a tale of two things wherein tractors didn't do well, but PVs did do well? He said, of course, that their market share has risen, so he's taking heart from that. But automobiles at large, Q3 largely driven by volume growth in the quarter, so that was fine. A better product mix and maybe lower commodity costs, which aided margins for automobiles by and large. So that's part one. There were some logistic-related challenges, maybe because of Red Sea or otherwise, for the exporters. And Aisha laid it out in its commentary very, very clearly. So that was part two. PV demand, very healthy for SUVs. What is not healthy for lower-end models wasn't the healthiest. That is part one. Two-wheeler OEMs expect a sustained recovery in both domestic as well as export volumes, which is a great thing, and Hero MotoCorp kind of amplified that in their commentary. Lastly, tractors are looking at a continuation of the cyclical downturn. Even Anisha wasn't able to say when did it end, and Escort's commentary was weak. So that was the overall. And very quickly to specific companies, because viewers need takeaways. Hero, they have said that the two-wheeler industry revenue should grow in double-digit in FY25. Hero expects to outperform the industry, so more than double-digit, which probably implies market share gains, and they expect margins to be on a gradual uptrend. Maybe because of pricing power. So Hero commentary looks fabulous. The stock has run up and all that, but the commentary was very strong. Ashok Leyland, on the other hand, wasn't as strong as Agam and Harsh. They guided that FY24 volumes are estimated to be below FY18 peak, and Q4 will see moderation in growth due to higher base. Escorts, similar story. We know what's happening with tractors. Domestic tractor industry expected to decline by 6 to 7% YOY. The Q4 volumes could see a 12 to 13% decline. So this is Escorts, and therefore tractors look wobbly. Aisha, amongst everything else, they said expect exports to recover from key markets only post 2-3 quarters. So it's not happening in the immediacy. So there is a bit of a weakness there too. Sorry if I'm sounding very weak, or I'm bringing out some of the weaker hands, but that's what's come out. Just lastly, auto components were a bit of a mixed bag. We know the standout was Bharat Forge because of what they've said, but companies like Sona, Comstar, actually sounded okay. They raised the EBITDA margin guidance, to over 28% versus a band of 25 to 27%. So that's one. And they said that the new order book has increased quite significantly. Of course, at the end, I'm ending with Bharat Forge's most famous quote of this earnings season, I would add, which is what Baba Kalyani put out and said that looking ahead in Q4 and further into FY25, we expect growth momentum to moderate.
Yeah.
Auto components a mixed bag. Autos too a mixed bag, as would be in most sectors, but clear trends that PVs are doing well, or the SUVs are doing well.
Yeah.
Tractors and some commercial vehicles are not.
Speaking of SUVs, there's one name which is not in this list, and that's Force Motors, which has given us a return of 4 to 5 times in the last 12 months. And that, of course, is possibly tilting the scales just a tad bit towards the positive end. And of course, it's also gained as much as 25% just in the last 3 sessions.
Wow. So, Force Motors,
Force Motors,
so
yes.
Forceful move.
Absolutely, yes. So, of course, SUVs, for good reason too, which is clearly pushing Force Motors upwards. But, well, thanks so much for that, guys. So there you have it. The update on how the quarter's gone by, and of course, a good insight coming in as far as the banking sector along with the auto sector that we've discussed in the show. And with that, it's a wrap on Editor's Cut. But we are going to be back on the other side of the break with futures and options. Of course, I'm going to take you through that and a lot more. Stay tuned in.
Right, back with India Market Open right here on NDTV Profit. Well, the implied open seems to suggest that we'll have a good start, and that's not that's welcome. But are FNO cues indicating that, and what are the FNO strategies that we should deploy for the market as well as specific stocks? Agam is here. Agam, Good morning. Tell us.
Good morning, Niraj. Well, we've seen a bout of short covering yesterday. A lot of your older shorts which are playing out have now been covered over the past couple of sessions, at least as far as index futures go. Let's take a look at how things are panning out. So the Nifty short did advance by just about 3.3%, but we are seeing unwinding to the tune of nearly 3% in open interest. In the Bank Nifty futures, the picture isn't very different because we are seeing an advance of around 0.7% there, and open interest declining by around 9.5%. So significant moves there. Let's talk about the options market. At the moment, we are seeing a substantial amount of writing, at least in change, around the 21,300, 21,400 calls as well as puts. And we're well away from that mark. We're not exactly there. We're more towards around 21,800. Still, we have a lot more activity around here. On the higher end, and we don't have that on the screen, but we are starting to see a lot more traction around 22,100, 22,200. 22,200, and that's where we are starting to see a little more writing as far as calls are concerned. Now, naturally, even as the Nifty advances, we start seeing an activation of higher level calls, which also means that the puts range will also move higher. So now we have max OI that's shifted in puts from 21,500 to 21,700. It's a 300 odd point range, but on the higher end, 22,000 isn't really a very strong one, because should we see the Nifty go above that, well, a lot of that could change. Moving on, as far as the Bank Nifty goes, 46,000 continues to be that pivot of sorts. So we'll be keeping an eye on that one. Let's talk about stocks then. And, well, we have seen shorts in Vedanta and Muthoot Finance, and Polycab, NTPC, and in MNMC longs. M&M is clearly the stock of the day yesterday, up around 6.5% on the Nifty. And in terms of stocks, we saw unwinding. We're seeing short covering for NMDC, RBL Bank and Gail, and unwinding in Hindustan Copper along with Apollo Hospitals. So we'll be watching out for all these names. But what are we doing with markets at the moment as we move into the next week as far as expiry is concerned? Well, let's get in an expert opinion. We have Soni Patnaik of GM Financial Services joining us on the show. Soni, good morning. Thanks for joining in. Let's start with your view on the key benchmarks, the Nifty and the Bank Nifty.
Good morning, Agam. Thank you so much for having me on the show. So I think rightly, as you've covered, Nifty and Bank Nifty both have seen a bout of short covering, which means that shorts are getting squeezed out of the system. Of course, there's no fresh longs that are getting added into the system. However, there can be seen short covering, plus your VIX is cooling off. Plus, there is also put writing happening. So all three parameters are indicating that there could be limited downside going forward, and the supports are rising up. So if we talk about Nifty, Nifty was struggling to break above the range of 21,800, 850, and we've seen that it has broken above those resistance struggle range, and it has closed above 21,900 also as well yesterday. Going forward, 22,000, 22,100, the previous all-time high holds as a resistance, but any move above that and Nifty can see a sharp rally towards 22,500. This could obviously be a positional play. On the downside, the support is also risen from 21,500 to 21,700, 21,800. So I think that range is holding as a very crucial support. And as long as the support is holding, I think, Nifty can retest its previous all-time highs of 22,100. Above that, it can definitely head towards 22,500, 22,600. Talking about Bank Nifty, which is very interesting at the moment, because Bank Nifty is a one that can actually lead that next leg of rally, provided it is able to cross its resistance. I think Bank Nifty on a very short-term basis, 46,200 was a resistance. It broke the resistance yesterday. It has even closed above it. So Bank Nifty at any point right now can test 46,800 to 47,000. As per the options metrics, the maximum option pain for Bank Nifty is at 47,000. So the moment it's able to cross this pain point, you can see further short covering continuing in Bank Nifty, which can lead it up to 48,000 level as well. And this is also on a positional basis. So I think both the indices are heading towards a positive closing as per the weekly closing today. So I think both indices can perform well from current levels.
All right, so short covering on the cards for both the benchmarks. But Soni, let's talk about stocks then. And I believe you have a strategy on Federal Bank. Can you take us to the structure that you're deploying there?
Absolutely. I think Federal Bank is looking quite positive from current levels. It has seen good put writing happening at low strike, starting from 145, 150 put. And going forward, also, it is holding quite well on the structure. So in the charts, there's a good breakout backed by volumes. There is a positive RSI and MACD divergence as well on the positive side. So Federal Bank turns out to be a buy from current levels. And also, like I've said, because Bank Nifty is looking positive, so this particular stock can outperform in the entire sector. So Federal Bank, you can buy on very small declines up to 155, keep a stop loss of 150 and target of 168. I think that's the first stock which is looking quite strong on charts.
Right, and you also have a position as far as ONGC goes. This one is also something that we've seen on a strong up move of late.
Yes, absolutely. I think ONGC is about to give its fresh breakout. So any move above 276 on charts will indicate a fresh bout of breakout, and it can head towards 284, 286 odd levels. So here the strategy is to buy a 280 call option of February series. The buying range is 4.8 to 5.2, keep a stop loss of 3 and a target of 9. So I think the moment it's able to do that on a weekly closing, especially if it's able to break out above the 276 resistance, it can definitely head towards 284, 286.
A favorable risk-reward ratio for ONGC as well, playing on a continued momentum there. Soni, thank you so much for getting us that update, giving us an idea on how the markets can pan out, as well as a handful of trading ideas. And with that, it's back to you, Samina.
Thank you for that, Agam. That is the FNO picture this morning. Like we said, implied Nifty is expected to show us a good start this Friday morning. We will be, of course, covering a few more sectors and conversations. We've got with us Probal Sen, who will join us in a few minutes to talk to us about what's going on in the oil and gas pack. But in the meantime, we've also got Avinash Gorakshakar, Director Research of Profitmart Securities, joining in with his view on the markets. Avinash, good morning. Thanks for joining us. Lack of triggers is what I believe is what's happening now for our markets. Do you feel like this is still a buy on dip market or a sell on rise? Because early this week, there was a lot of noise about how this has become a sell on rise market.
Yeah, good morning. See, my sense is that this is definitely a buy on decline market because if you look at the broader market, Samina, I think there are many companies which have shown very strong Q3 numbers. The management commentaries have also been very encouraging. So I think, you've got to pick and choose in this market. I think the broader index may not show a major rise. Although today we could see a positive opening in the early part of the trading session. My sense is, stocks within the auto components, capital goods, real estate, cement, these are pockets of opportunities where any decline could be used as an opportunity to accumulate positions. And I think the markets would now be looking at, some sort of, local triggers, especially on the election side, because earnings season is almost complete. And I think markets would now be looking at what is the kind of timeline for the election schedule. So I think markets are now well poised to hear what the government puts out in action. And obviously, corporate action has also been pretty solid. My sense is that, at least on ground reports suggest that real estate, cement, steel, slowly, I think demand is picking up. So I think broader market, there could be good opportunities. In the large cap, we have been very positive on the large capital goods players, on the cement companies. So I think, one has to take a slightly longer term view now because markets have risen very fast. So one has to be selective and the time frame has to be slightly longer. So there are opportunities, but yes, in the short term, the markets could be a little bit range bound.
Okay. Avinash, the star of yesterday's session has to be Mahindra and Mahindra. What did you make of the commentary? Because the street clearly liked what the brokerages saw in the conference call around the SUVs and the auto segment as opposed to the tractor segment. Is there more juice left here fundamentally?
Yeah, I think, Niraj, first of all, good morning.
Good morning. Good morning, of course.
My sense is Mahindra and Mahindra has always been a stock which has not performed triggers. The company has been putting a lot of effort on the electric vehicles side. SUVs, they have been dominating the market. And I think the current condition of the market clearly indicates that the volume growth pickup is basically very strong in the larger SUV segment. I think product development wise, especially both on the ICE engine and the electric vehicle kind of product bouquet has been very strong. So I think you're going to see a lot of action in the coming year. And most importantly, I think, of course, the tractor market has been going pretty slow. But the automotive market has been the market where a large amount of volume share, a large amount of profit margins could possibly come in. And I think we've seen a lot of new product development happening. So I think markets should obviously look at now how these narratives are going to get converted into numbers. I would not be surprised we could see levels of even 1900 or 2000 because fundamentally, Mahindra on a standalone basis as well as on a consolidated basis looks pretty attractive. Even at these levels, I would not be surprised that you could expect a decent risk reward over the next, say, 12, 18 months.
Right. By the way, just on Mahindra and Mahindra, just before we go on to the other things, there is a very interesting note by Morgan Stanley today. They ask a question about whether can M&M be the fastest growing passenger vehicle OEM in FY25, and amongst other things, they seem to refer to things like whether we can learn from what can we learn from the Bajaj re-rating, starting point, Hero was the cheapest two-wheeler OEM, so on and so forth, and driven by a lot of factors, can in some sense M&M do an encore of sorts. So interesting note and something similar to what Avinash was just telling us.
No, it's interesting, and there've been a whole bunch of upgrades, Niraj, on M&M, and it did lead the way up, led from the front in yesterday's trade. Maybe we can dwell on this a little bit more in editor's cut over the next couple of days. But talking about trade yesterday, there were quite a few bulk deals that dominated the street. Varsha's got more details on that. Varsha, what happened yesterday? A few fairly large deals, bulk deals that we've picked up on after closing yesterday.
Good morning, Samina. So as you rightly said, so let's start with Yes Bank, wherein CA Basque Investments, which is an affiliate of Carlyle Group, sells almost 1.35% stake. Now, deal value is 1,000 crore. Morgan Stanley has bought a 1.06% stake. Deal value is at 830 crore. Now, if you see, both the transaction are at 27.1 per share, and the shareholding pattern. So as of December 23, Basque held almost 6.43% stake, which will now taper off to 5.08%, and these investments were bought somewhere in 2022 at 13.78 per share. So shares are sold at almost twofold premium. Then we have Sudarshan Chemicals, wherein Nisha, the promoters have sold their stake. So Nisha Rathi has sold entire stake, while Ajay Rathi has sold 2.02% stake, and HDFC Mutual Fund is the buyer for this transaction. And if you see the current holding, as on December 23, Nisha held 0.58%, while Ajay Rathi held 0.98%. And lastly, we have Vedanta, where Finsider International, a promoter group, sold almost 1.76% stake. Deal size is at 1,700 crore, and the transaction price is at 265 per share. And shareholding pattern, if you see, as on December, they held almost 4.4% stake, which will now be 2.64%. And also, I would like to mention that 11.9 crore shares changed hands in multiple trades yesterday during the day. And according to media reports, promoters are in talk with GQG partners to pair stakes of almost $1 billion.
Right, Varsha, thank you for that. Lots of bulk deals that hit the market yesterday. We have this Kush Bohra as well, founder kushbohra.com joining in. But I'll first, of course, Kush, we'll start with this and then go back to the broader market call. But very quickly on Yes Bank, we did see a very large bulk deal on the stock yesterday, after, of course, when the data came out. On the charts, what does Yes Bank look like? It's had a pretty sweet move, what, 28% higher in the recent past?
Oh, absolutely. One of the last few banks to sort of catch up in the rally. But I think it's a good idea to keep booking some profits along the way. Probably Avinash can discuss more about the market cap and the other perspectives. But if you see, the stock has seen a lot of supply pressure. Every time it's sort of tried to rise and move up. Even here, I think 32, 33, the recent high that the stock made could act as a near-term resistance. So from a near-term perspective, I think the risk-reward ratio is perhaps not as favorable. So for me, if someone's holding this for a while now and is making good money eventually, then it's a good idea to take the money home.
Okay. Kush, what would the view on markets be? Are you constructive the Nifty?
Niraj, what we're looking at is 22,500. If you see practically for the last month and a half, 2 months, the market's not gone anywhere. I think this time around, we'll not only be knocking at the doors of that, 22,200 high, we'll probably sort of 500 is what I'm looking at Nifty by, let's say, the end of March. The missing piece in the whole puzzle was Nifty Bank. Now, I'm not saying that out of the woods, But the fact that we've taken support, considerably at the 200-day moving average, and that we've closed above the 20-day moving average for last two sessions now after about a good month or so. I think the participation will come in from here. Even if it just holds up at these levels, I think the other sectors will perhaps do their magic. In fact, even on Bank Nifty, we're constructive. We're looking at a target of 48,000. So all in all, a bullish perspective from here on. 22,500 on the Nifty and 48,000 on the Bank Nifty are our position targets by the end of March.
Right. Kush, very quickly as we're gearing up for trade this morning, what are your top picks?
So, given the optimism around the banking names, Bank of Baroda, one stock in the PSU pack that hasn't participated. So, from a near-term perspective, 282 and 288 are the trading targets. 270 is where I would keep my stop loss. The energy pack, has been in theme, didn't really lose its favor. So, Swan Energy is the second pick that I have. 755, 770 are the levels that we're looking at, and 725 is a good support zone.
Right. We also have with us Probal Sen, Senior Research Analyst for the oil and gas sector, joining us from ICICI Securities. Probal, hi, good morning. Thanks for joining in. We last spoke about maybe 4 to 6 weeks ago. And since then, the euphoria, the excitement for the oil and gas pack hasn't stopped. Look at OMCs, upstream, downstream, the gains are across the board, right? Anything's changed? Why the euphoria? What is looking different today than it did a month ago?
Honestly, the rally really started about 3 to 6 months ago. You're right that it's picked up pace, probably more so in the last month as the results have started to come in. What happens in the PSU oil and gas space, at least in my experience, is that people wait to see the results before making up their mind, irrespective of what you think is built into the price or what you think is built into the estimates. A lot of the times people would wait to see the results actually coming through and then basically adjust their estimates. I'm talking from a investing standpoint. So as 3Q results have actually come in and have sort of reinforced to a large extent what was being spoken about earlier, that the results are going to remain fairly strong. The price band of both oil and gas remains in a fairly sweet spot at this point of time. And both from a margin perspective as well as from an operational perspective, I think most companies, including the OMCs or upstream, are actually seeing a sort of a structural revival. And that, is fairly important from a re-rating perspective. The other thing that is, of course, happening is OMCs and rather PSU oil companies are benefiting from the broader trend that we have seen of, a huge amount of interest in PSU companies and their prospects over the next couple of years. So it's a combination of every factor that has driven it. Yes, I mean, in some stocks, obviously the extent of uptake is a little bit surprising, but as a directional trend, I think this is something that we have been saying for a while, that these companies are due for a sort of a structural re-rating across the board. Whether you look at Gail, whether you look at HPCL, whether you look at Oil India, whether you look at ONGC, there's a lot of factors that have gone right and will continue probably to improve over the next 12 months.
Probal, let's take this one at a time, and I'll start with Gail simply because that's the order of your report as well. You maintain a buy target on this one. You've pretty aggressively raised your target price as well. And you also believe valuations look compelling, even now, even at these levels?
Yeah, I think, as I said, what one has to sort of get out of it probably is that the prism of looking at these companies from a perspective of the last 5 years or last 7 years is not going to sort of, deliver much benefit, because if you look at Gail in particular, the factors that are actually driving a near doubling of EBITDA over the next 3 years haven't really existed at the same time for it any time in the last 5 years. You've got a 15 to 17 SCMD improvement in volumes for transmission. You've got a similar improvement in volumes for trading and a much more stable margin regime because of the fact that most of the US LNG will now flow into India. There's a clear margin uptick in comparison to spot LNG, even at these reduced prices, because Henry Hub has also fallen in line with how spot LNG has done. You've got input costs improving for the petrochemical segment, which has been a laggard for a long time. Thanks to the spot LNG reduction, petrochemical margins should also at least get to EBITDA break even and stop making losses. And in LPG, prices which had dropped to as low as $410 a ton are now hovering at around $600 a ton, plus domestic gas costs for the segments are at now $6.50 an MMBTU. So you put that together, you've got a clear case for EBITDA basically going from levels of 7,500 or 1,000 crore that they did in FY23 to well over 15,000 crores by FY26. Now, what multiple you give to that? Do you look at it from a perspective of what they have done historically? Do you look at it from a perspective of what the Nifty is trading at today, if you look at a 1 year forward multiple? Or you look at basically saying that, listen, this company, is going to continue to do extremely strongly, and therefore it needs to be looked at in a different way than what we have done before. I think it's probably, a combination of that. Our sense is that the stock can probably deliver outperformance over the next 12 months because the business is going to continue to surprise positive. Exactly what multiple it will trade at, frankly, is anybody's guess. So, that remains a moving target, I think, as of now.
Probal, but the question that I would have, therefore, for a Gail is that if indeed you expect it to deliver, and one of the three scenarios that you laid out could well happen, are you conservative with the targets that you have? Because it's at 184 currently, any which ways.
Well, right now, the way the stocks are moving, I'll have to put out an update in terms of target prices. So it's a little bit challenging. I agree with you. As I said, the extent of the price movement and the pace of the movement continues to take us by surprise. Oil India, we were expecting the stock, for example, to react positively, but I was definitely not expecting a 12% move up. So obviously, I think there is a little bit of euphoria that gets built in when numbers are getting delivered, targets are getting upgraded. So one will have to probably look every 3 to 6 months to look at what is a fair price target. But as I said, I would expect that given that the business, if it continues to do as well as we hope it will, I think the stock will probably react accordingly. That's why I'm saying that, it's a little bit difficult to pin a target price at this point of time because the stocks just keep running ahead, pretty much every week of what we are looking at. So,
very interesting. We were going through all the stocks that you seem to like. BPCL doesn't feature on the list, does it? You've got a buy call on HPCL, but you avoided a call.
No, that's not the reason. Unfortunately, BPCL and IOCL is on our restricted list.
Okay.
So we don't have an official view and rating on the story. As I said, we're positive on the OMCs overall, but those stocks we can't discuss.
Sorry, Probal, just wondering very quickly, is there a risk of any kind of pricing cuts ahead of elections that could dampen the spirits of the OMCs or no?
I think that, the risk of pricing cut is probably there in gasoline now. Diesel, if you look at it, the marketing margins have already come off because of the kind of strength that diesel prices have shown in the last couple of weeks. So the margins for diesel are no longer, at supernormal levels. They have come down to less than 2 rupees in the last couple of weeks. But in petrol, yes, there could be a price cut. But the fact is that margins have been continuing to be in a very healthy range of 7 to 7.5 rupees. So as long as the price cut is reasonable and margins are maintained at a normalized level of 3.5 rupees, I think that is what the street is at for FY25 in any case, in terms of normalized earnings. So, while there could be a trigger and there could be an event-led, dip in the stocks, I don't think that it sort of, spoils the story in any way from a slightly longer-term perspective.
Very lastly, Probal, if an investor wants to get into the oil and gas pack today, keeping in mind everything that's happened and your calls, give me 2 or 3 stocks that you're still constructive on, despite the very sharp moves some of these counters have seen in the last few days. So just 3 stocks if an individual is looking to buy the oil and gas pack.
If you can permit me to name 4, I would continue to say HPCL, Gail, ONGC and Oil India. And then in the CGT space, the last name would probably be MGL is what I would continue to look at.
You're giving me 5. Now I'm gonna make it harder. Give me just 1 then, because there's only that much amount of money available to buy stocks, right?
Right. Give you just 1, okay. I think probably Gail would probably be one name that I would continue to look at.
Probal, so good having you. Thank you for taking the time out and being with us and giving us your thoughts. Viewers, please use your discretion. Nothing is a recommendation in that sense. It's their recommendation to their clients. Keep that at the back of your mind. We need to slip into a quick break. We'll be back with the pre-open session.
Welcome back. Pre-open is be upon us in a few seconds. It is going to be a positive start from the look of it. We've actually had a pretty good week, a pretty good second half of the week. Wednesday, Thursday were good days of trade. Wednesday, remember, we did get a massive gap down in terms of opening. Nifty was sub 70 at 21,600, but that got filled up beautifully well in the second half of trade, and that has what given some confidence to the bulls on the street. Flat start, we're still sub 22,000, but stable is the kind of start that we are expecting this morning. Well, we've talked about M&M, we've talked about a few other names as well. Yes, too, but I want to quickly come in on another counter that made quite an attractive move yesterday. Avinash, HDFC Bank turned out to be one of the top gainers in the session after very long. Do you feel like the bottom is here and now there is enormous amount of value and there's really no reason for anyone to avoid HDFC Bank?
Yeah, I think clearly, from a longer term perspective, the value looks very attractive because you're getting a bank which is of a global size. Now the merger has got completed. My sense is, if investors are looking over the next, say, 12 to 15 months, this is a good entry point for a decent amount of risk reward. And most importantly, numbers which came out in the third quarter, I think have been quite solid. In fact, asset quality, loan book growth. I think the only key point which the market was disappointed was on the deposit growth. So I think we'll have to wait for a couple of more quarters, but I think clearly, the bank looks to be well positioned. And I think a lot of traction is going to happen by, cross-selling HDFC Bank's products to HDFC, customers, which I think has not yet happened fully. So that is going to happen in FY25. So I think around 1400, 1450 would be a good starting point to accumulate. I would not be surprised that we could see a good 17-18% upside over the next, say, 12-15 months. And I think the markets probably would get a better sense, from the second half of FY25, when I think some amount of cross-selling happens and, that narrative which earlier was mentioned by the market gets converted into numbers. But I think the management commentary has been very solid. They have been very positive on the, overall asset quality, loan book growth. I think deposit growth is one thing which I think is not only impactful for HDFC Bank, it's across the industry. Deposits are now going to get more and more tougher. So I think we'll have to wait and watch. But yes, I think one can definitely look at accumulating, HDFC Bank at the current level.
Okay. Thanks for that, Avinash. So watch out for HDFC Bank from an accumulation perspective. Kush, I have a follow-up to the picks that you gave because you seem to be tracking this Swan Energy very well. It did really well in the last time you spoke to us. Are there longer-term targets that you have on this one?
So the only caveat here is that, on the monthly charts and the weekly charts, the stock has actually gone into a bit of an overbought territory. So from a longer term perspective, there's obviously, traction, and there is obviously, upper levels that we're seeing, 800 to 825 kind of zones are, very easy, very convincing kind of target. But from a longer term perspective, my suggestion would be to buy on dips. However, there's also, the recent momentum that's taking the stock higher. If you see in the last, about 2 to 3 months, the stocks barely touches 20-day moving average, if at all. So the recent momentum is what is, making us put this out as more of a trading call. However, given the entire energy pack moving higher, 825 I think is a very conservative target on Swan Energy. But as I said, for that buy on dips, there will be bouts of profit booking along the way.
Okay, watch out for that. The other one is this note from Jefferies on aviation stocks, right? And on aviation, wherein they said that the domestic air passenger traffic growth has come off and Indigo's market share, more importantly, has slipped to 60.2%, lowest since May 2023. Avinash, in the thick of things, supposedly the default in line for more, it is now finally finding some good competition from the Air India plus Vistara combined. What's your and there is some grounded fleet as well. For somebody who's holding Indigo or Interglobe Aviation, is it good time to book profits, or are you constructive?
No, I think, Niraj, I would be more constructive on Indigo, considering the fact that, this data point on market share slipping to its lowest level. I think we need to wait for a couple of more quarters because aviation traffic, according to me, is actually going to get more and more better with the kind of buoyancy we are seeing in the hospitality hotel segment. And most importantly, business travel has resumed quite well. So my sense is, but the biggest trigger for them is that crude prices have softened quite well. And if crude remains at these levels for a reasonably long time, then yields are going to get better. Their capacity utilization has also been pretty high. So I think if crude prices remain soft, I think you'll see a decent amount of profitability coming to Indigo. I would not be negative on the stock as of now. Investors who have the stock should hold on. The stock has moved up, so there would be some amount of consolidation. But if you're looking at FY25 numbers, I think definitely, the company should do well. I would think, players like Vistara or typically, the other players like SpiceJet, they have the size and scale like Indigo. With a 60% market share, I think clearly the bigger beneficiary of the crude oil price cut would obviously come to Indigo. And next 1 or 2 quarters, I think hopefully, I think things should look better. So I think one bad number on the market share should not lead to a complete derating on the stock. I'm pretty positive that the stock could bounce back, and I think you could see better numbers for the March and maybe the June quarter, forthcoming.
Kush, what about you? Aviation this morning, how would you trade it?
Well, personally, never been a big fan of this sector. There are only a handful of stocks globally that have made money for investors, and one of them happens to be in our country. So proud of that. Again, I've got a few other names that have actually done well, will continue to do well. So not a big fan of aviation stocks. However, given the recent setup, there is a possibility that we could see some more profit booking on Indigo. There is something called a negative RSI divergence, very clearly evident on the weekly setup in Indigo. So I won't be surprised to see the stock perhaps slip to 29, 29, 50 kind of zones. Closer to that, perhaps will be a good time to start accumulating if someone's looking for an entry point.
Right, that's the Interglobe and SpiceJet space, fundamentally and technically view coming in from Avinash and Kush. Also if we are talking about stocks that are expected to see or have seen movement in the last couple of days was Oil India. Kush, did you see that sharp up move? Earnings were good. A positive reaction could not have come out of nowhere. But these oil and gas stocks have been on a tear, and yesterday the day really belonged to the way Oil India played itself out.
Samina, how could I not? I was quite enjoying the conversation that you had with Probal, all ears open. Beautiful conversation, by the way. Again, these stocks have traditionally not been known to be either trader favorite or investor favorite, anyway. But the kind of moves that we've seen, they've certainly brought it, these stocks are now on everyone's list for sure. Oil India, yes, for example, the yesterday move that we saw, there's a possibility that we might see some sort of cooling off from these levels. It was a sharp up move, although it was volume backed. I think there is some, cooling off that can happen. One stock that Probal could not mention because of the restricted list, and I have on my radar, is IOC. So from the entire pack, while everything is doing well, I think IOC is one stock, that could perhaps, continue, its up move rather fast, and it's a derivative counter if someone's interested. So 210, 215 are the levels on the upside, and a good support zone comes in at about 180-ish. So IOC is something that I have on my radar from this space.
IOC is your pick. It was Gail's pick. Probal's pick clearly was Gail. So we've got two stocks for you on the charts. Kush recommends IOC, and fundamentally Gail is looking good as well. Well, Avinash, you want to come in on this one? We've already talked to Probal and had a deep conversation with him. But any one stock that you like from the oil and gas pack that still looks good?
I think I would go with IOC, as Kush mentioned, because the numbers have been pretty solid. And oil marketing companies, according to me, would be the biggest beneficiaries of the softening in crude prices. I think both the auto as well as the aviation sector, according to me, the throughput has increased significantly. And I think that is going to be the key trigger for them. Of course, the near-term, short-term caveat is that ahead of the elections, we could see some sort of price cuts being announced by these companies on petrol prices. And that possibly could have a short-term negative impact. But I think around 180, 190 IOC could be accumulated. I would not be surprised that the next 2 quarters, hopefully, if crude prices remain soft, you could see levels of at least 230, 240. So, of course, the election, news flow is important. But fundamentally, this is one of those companies which looks relatively, attractive as compared to both BPCL as well as HPCL.
Right. Those IOC technically and fundamentally looks like a good buy. That's the view coming in. Well, in the meantime, pre-open is expected, should be wrapping up very shortly. It is expected to be a flat to slightly higher start. It could be a day where we might get a gap up and may be positive, but see some profit taking as we go into the weekend in the second half of trade. Kush, we've talked about a bunch of counters, but one that I want to quickly try and get some perspective on you from is on the IT pack. Yesterday they played catch up after declining quite sharply on Wednesday. Across the IT pack, anything that's looking good in the charts for a quick trade, maybe for the Feb series?
This is one stock that has never featured on my list up until about 2 weeks ago, and that's Wipro. The stock has actually done rather well for itself. There's a rounding bottom formation that has come to a close, and the stock actually closed above that. So Wipro, I think, has good times ahead, if you ask me. It's got a lot of catching up to do from with the names of TCS and Infosys and HCL Tech of the world. This is the fourth big name. Hasn't really done as well compared to the others. But I think perhaps at least now the momentum is in its favor. The volumes have seen a pickup. So from a near-term perspective, I'm looking at a target of 535 and then perhaps even 550 positionally. And a good support base comes in at about 495, 500 kind of zones. So Wipro's on my radar. The stock's actually, as I said, completed a rounding bottom formation and could see further upsides from here on.
Well, let's see if that were to happen too. Could be an interesting one. Now, Avinash, fundamentally based on results, what has stood out? Let's say mid caps, small caps. Is there a name that has looked interesting to you based on the commentary that the companies come out with?
No, I think, Niraj, we've already discussed this stock earlier on your show. We continue to like Anantraj, from the real estate pack. I think the third quarter numbers which have come out have stood out very strongly. In fact, now the data center capacity has gone up to 21 megawatts from 6 megawatts. So you could see a significant amount of traction in the coming financial year. And I think profits were up by almost 45 to 50%. The EBITDA was up by almost 55 to 60%. I would not be surprised that over the next, say, 12, 15 months, as the data center business gets scaled up, there is definitely, it's a very sweet, profitable business, enjoys a EBITDA margin of almost 65%. So, you could assume that next year, possibly you could see a top line of 200 crores coming in only from the data center business. And of course, the real estate business remains the cash cow. So I think technically speaking, we could see levels of around 230, 240 crores profit for the current financial year from last year's 150 crores. And for FY25, we are looking at a profit of almost 330, 340 crores. So I think very strong earnings growth. And plus, they recently made a preferential to some marquee investors. So, that means that the stock is now in strong hands. So I think one could look at levels of at least 400, 425 over the next, say, 12, 15 months.
Right. The star of yesterday was M&M, and I wouldn't rule out it being the star today as well. Morgan Stanley's come out with a bullish call on M&M. They've raised the target price as well, and Tushar is standing by with more on it. Tushar, everyone seems quite excited after M&M's posted its earnings.
Yes, certainly, Samina. Good morning to you, and good morning to you, Niraj, as well. So, Morgan Stanley now is saying, after the run-up that Mahindra & Mahindra saw yesterday, that Mahindra & Mahindra can be the fastest growing Indian car maker in FY25, while rating the stock overweight and putting an 11% upside to the stock. Now, why does it believe so? So Morgan Stanley says that M&M's SUV sales may grow at 13% to 43,000 units per month. Declining order book as well as demand, the demand that has actually sustained, and the reducing waiting periods are actually key triggers for that assessment that Morgan Stanley has given. A couple of launches in the first half of the year, Thar 5-door as well as a new XUV 300 will also premium products, which will also aid margins as well as push growth, as all new launches do. But there is some pain point, that is the tractor sales, which will clock a CAGR of about 2% over FY24-26. The rate of decline, however, in the tractor sales will narrow through FY25. So essentially, production is increasing, order book is decreasing, waiting periods are decreasing, but demand has sustained. So that works in the favor of M&M.
Okay, well, let's see. 1.3% higher for Mahindra & Mahindra. We took a fundamental view on this one, of course. Very interesting to see what the stock does today after the 1.5% uptick that we've seen. Kush, maybe a 20-second view. What are the upside levels for Mahindra & Mahindra? Very quickly.
1800 plus very easily.
Okay, 1800 plus very easily is what Kush Bohra is saying. Kush, thanks for that short answer. We're just very close to, perilously close to market open. So now let's focus on that. We'll have to focus on what the oil marketing companies do in particular, because BPCL has gotten a strong upgrade. There's also this whole thing about how FMCG stocks took a beating yesterday, but PSUs were in the green lane in a big way. So I think focus will also be on the PSU stocks this morning, on the index as well. Let's pull up the live rates though this Friday morning after 2 days of an uptick. About 22,000 yet again, or just about that. Sorry, slip below it or in and around that, but about 80 or 90 odd points in line with what the pre-open session had suggested, or the implied open session had suggested. Bring up the Bank Nifty and bring up the mid caps and the small caps. Bank Nifty not with as much gusto. Yesterday too, Axis Bank had dragged the Bank Nifty lower a little bit, if you will. But the mid caps and small caps had a terrific outing yesterday. Let's see how they're starting off. About 0.7 for the small caps. And I believe the mid caps would probably also be looking strong. 0.43. Let's get the heat map up and see what's happening on the gaining side. BPCL and M&M, the top two gainers of yesterday, are the top two gainers of today. Big move on BPCL because courtesy, I think, that Jefferies upgrade, 3% higher now. There is strength in Tata Motors, there is strength in Coal India, and IT is doing well. There is Infi, there is Wipro, there is HCL Tech. Three names doing very well. LTI, Mindtree and Tech Mahindra, two in the green. But overarchingly, a lot of green, very little red, which is one good part. ONGC is the lone ranger of sorts, which is sulking. Though Axis continues to sulk from yesterday, was down 2%, is down about 1/3% yet again, or 1/4%. But Samina, the news seems to be that yes, ONGC has a bit of a hiccup, but the gains on some of the winners from yesterday, M&M, Infi, and BPCL in particular, very strong.
You know, we were talking about Force Motors this morning. BPCL has done about, what, 15-16% in the last 2.5 days. So you also have them that are doing really well. But Niraj mentioned Jefferies upgrade is probably giving another leg up to BPCL. It's giving a leg down to Gujarat Gas. Jefferies downgraded Gujarat Gas, and a reason, and of course, what that has led to is a big fall on the stock this morning. But a whole bunch of other downgrades and upgrades I'll take you through. NMDC, which was quite the performer in yesterday's day of trade, is seeing some weakness this morning. So what we are seeing is the counter seeing selling pressure down about 1%. Now these are not big losses, but definitely worth a mention. Remember, the broader market sentiment is positive, so the reactions may not be as dramatic, at least on the way down. So 1% low on NMDC on back of the City downgrade. We talked about BPCL's upgrade. HPCL on the other hand hasn't got an upgrade, and neither is Gujarat Gas. BPCL is up now a whopping 4%. HPCL underperforming, and so is Gujarat Gas. Take a look at what's happening in aviation. Jefferies' note on aviation would have some sort of an impact, you'd imagine, on aviation counters. Actually interesting, they're ignoring any sort of concerns that Jefferies has laid out. You've got Interglobe that trades flat, and that's pretty much where it stands at. A couple of bulk deals that happened yesterday. One was Yes Bank, where Carlyle actually sold some stake to Morgan Stanley. The stock getting a leg up on Morgan Stanley buying at about 30 odd rupees. The stock is up 2.5%. So there's a little bit of a premium that Morgan Stanley picked this up at, and that is helping Yes Bank do quite well. So Darshan Chemicals also up 3% on back of that bulk deal. One last counter, one of the fewer earnings that came our way was EPAC Durable. Good earnings for EPAC Durable. They've changed substantially on top line, profitability, EBITDA, and the stock is one of your top gainers this morning on back of very solid earnings. So 7% on EPAC Durable is what we have. So all in all, that's how it looks, Niraj. But I mean, it is stable. The breadth is good. Broader markets are looking good. But I think it wouldn't surprise me if the second half of the day goes into a little bit of a profit-taking mode.
Could entirely happen. I'm just trying to see, Samina, that while we wait for the second half, what is it that is making the moves? So I must say, the BSE 500, the top gainer has only a 6.5% uptick. So it's not that it's a blowout gain out there today. Usually we see double-digit numbers here at the start. It's not happening today. Rain Industries and Aegis Logistics are two names which are standing out with about 6.7% kind of gain. So should pull those one up for you. There is strength in NBCC yet again, 4.5%. There is strength in Glenmark, which is up about 4%. BPCL is, of course, up there. And Bank of India, I think, has gotten an upgrade, and that stock is doing well. We'll be talking to the management of GE Shipping today. That stock is up about 2.5% at 976. So watch out for that one as well. And while we mark the gainers, and just before we go to Kush Bohra, it'll be good to mark some of the losers in the session today at the broader end of the spectrum. Gujarat Gas, courtesy the numbers and the most brokerages being circumspect on it, is down about 5%, is the top loser today. So watch out for that one. RK Forgings is down about 3.5%, so that is sulking a bit in trade. And there is weakness in GPPL, by the way. Yesterday was amongst the best performers. GPPL sees a bit of profit booking today, so watch out for this one.
Just a quick one. M&M has hit a fresh record high this morning, 17.95 on M&M. All that's working in its favor are all those brokerage reports as well, 1% higher. It made that high of 17.95, it's eased off just a little bit from there, but worth noting, it's actually been a good day. You talked about Gujarat Gas. There was a Jefferies downgrade on that too, and of course with that, MRPL also is lower this morning, but let's not forget the kind of rally they enjoyed in trade yesterday. But I'll come back, and of course Paytm is also trading slightly weaker. Kush, anything that you've picked up? It's 9:20. Markets have just opened up. It's stable, no runaway gains like Niraj said. Usually our top gainers in the broader markets are double digit. This morning you're seeing the top gainer to be up about 7-8% at best.
TGIF, I suppose. That's what's playing out on the mid cap and the small cap names. What's heartening is the fact that Nifty is holding its gains. The 22,000 mark is held. I mean, there and thereabouts, but it's largely there. I think the put base will start to kick in, sometime. Perhaps in the second half, and I think we'll maintain the 22,000 mark. So I'm looking at the 22,500 level very closely in the coming week. A couple of stocks that have actually caught my eye. KPIT Tech continues to do well. The round of profit booking seems to be done and dusted, and the stock is now moving higher. So watch out for that one on the upside. And one more stock that I have on my radar is Ipca Labs. The stock here too, we've seen a round of profit booking and is now starting to inch upwards. So 1,200 and 1230 are the levels that I'm looking at on the upside, and on the downside 1155 is a good support zone.
So KPIT Tech and Ipca Labs, Kush is constructive on both of these. Across the Nifty 50 names, the breadth, like we've pointed out, is actually pretty good. On your top gaining stocks, you've got BPCL. Kush, this is just not stopping, almost 683 now, 5% gains on BPCL. Would it require bravery to make an intraday call on this one right now?
Oh, absolutely. And the fact that, it's a Friday, also the fact that it's gone into overbought territories, and the fact that it's coming close to a round figure of 700 where you usually see a call base, I think the risk reward ratio from here on is not favorable. I'll wait for a dip close to, those 665 kind of levels for any kind of fresh entry. Otherwise, I'm pretty happy giving it a miss.
And a couple of other stocks that are moving this half morning, smaller ones. BL Kashyap is actually up and about. They won an order of 200 crores. The stock is up 4% now, so it's off the day's high point. Dilip Bilcon is up. They've secured an order in Madhya Pradesh for a water irrigation plant to the tune of 400 crores. The stock reacting well to that, up about 6.5–7%. Tata Motors, of course, Niraj mentioned, is also up quite sharply. They're considering a spin-off of the battery business, 2.5% high on Tata Motors as well.
That has been a revelation of sorts, just the way it's moved.
Yeah. You'd imagine this morning would belong to M&M, right? But Tata Motors sprung out of nowhere and decided to reclaim to become the talking point. Kush, Tata Motors, I mean, this is, the moves have been commendable. Fundamentally, of course, is a completely different story. But on the charts with Tata Motors,
just to your point about M&M and Tata Motors, I think Tata Motors will actually do a little better than M&M. That's our view, internally as well. But for now, it's come close to that 940, 950 level where, it had taken a bit of a resistance. So we might see some sort of consolidation here on, but positionally, we're looking at levels of 995, and once that is taken out, 1050 on Tata Motors. The rally for the last few months has been, commendable. We've gotten so used to stocks hitting new highs and roaring every day and every week that a couple of days of consolidation also seems like a profit booking pause. Not to be the case. I think Tata Motors is headed to 1,000+ levels very soon.
Okay, Kush, just one last word. I don't know if we spoke about Gujarat Gas, but if we haven't, before we let you go, A word on Gujarat Gas.
So, Niraj, typically these counters have not been, our favorite in terms of, like a positional buy, more on trading bets. Right now, the stock is languishing below its 20-day moving average. We are seeing some sort of pressure. So, for me, Gujarat Gas for now is an avoid.
Okay. Kush, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us those thoughts. Really appreciate your time. So that's the long and short of the trade pattern. Now, we would have asked Kush about GE shipping as well, but what we'll do is we'll ask the management about that because we get the management on the other side of the break to talk about what's happening on world trade as well as their quarter. But, as per IMF projections, we've seen that after the recessions in UK and Japan, India probably has the opportunity to become the 4th largest economy soon, as per what math seems to suggest. Pallavi Johnson with some context. Pallavi, could 2024 be that year?
Now, one of the top global headlines yesterday was the economies of Japan and the United Kingdom entering into a recession. But what does it mean for the Indian economy and what does it mean for the average Indian? Now, let's start by answering the first question. India's economy is already larger than the UK's. According to the International Monetary Fund, the size of the India's economy in 2024 is projected at $4.1 trillion. This means that the Indian economy is the 5th largest even this year after the United States, China, Germany and Japan. Japan is the 4th largest economy in 2024 and is projected at about $4.3 trillion. Remember, India is at about 4.1. Now, in about a decade, the Indian economy has leapfrogged from being the 11th largest in the world to being the 5th largest. And India is expected to continue to remain among the fastest growing major economies in the world. This, coupled with the recent degrowth that Japan has seen, brings us to the question that when will India overtake Japan to become the 4th largest economy in the world? Now, according to the IMF's projections, the likely answer is 2026. But given the current macros, it's possible that it could be a lot sooner. All said, while India is a large economy on an absolute basis, it needs to continue to grow at the pace it's been growing to lift the fortunes of its vast population.
Well, a contracting economy in Japan and the UK and expanding economy in India could, of course, mean that we may just become the 4th largest economy in the world. With that, we'll take a quick break. The markets are steady, but on the other side, one of the top gainers in trade today is GE Shipping. The stock's up nearly 2%. The management of the company joins us right after this break, so stay tuned.
Back with India Market Open right here on NDTV Profit. A couple of global economies like UK and Japan have slipped into recession. Trade data suggests non-oil and non-gold imports into India as well, which is, this data is the last, India is the last bastion of growth, is also lagging, indicating that a consumption slowdown may well and truly be underway. One of the best proxies of what could happen to global growth are oil, which the prices are lower, and then port and shipping companies, which are deep insiders. We've got one such insider in our studio today, Mr. G. Shivakumar, Executive Director and CFO of G Shipping, to talk about how is growth shaping up in light of all of this data and how would shipping companies do or shipping business would do in such a scenario. Mr. Shivakumar, great having you. Thanks for taking the time out.
Thank you for having me.
Broad brush, independent of the business that you are in, does analysis of your business and shipping of both container as well non-container ships per se suggest that there is an imminent slowdown underway in the world? Because high 50,000 feet data, UK, Japan, etc. seems to suggest that.
So on the commodities front, we haven't seen demand disappoint. So we are at trend for oil demand, at least. China imported a lot of tribal commodities last year, so there was growth year on year. We don't know about finished goods necessarily, but there does seem to be demand because the rates were pretty good and are pretty good. And a lot of this is driven by disruption in supply chains, just having to take longer routes, which results in higher requirement for ships, really.
Okay.
So, but on the commodities front, there doesn't seem to be any great slowdown in demand. We are going at trend, 1.5 million barrels a day growth in oil consumption worldwide.
Okay.
Do you feel like if we look a few quarters out, so what we've talked about in the data we saw is as of now, as of today.
Yeah.
In terms of inquiries, in terms of pipeline, in terms of your customers, your clients, do you feel like that uptick will continue 2 to 3 quarters out?
So in commodities, we don't see anything far in advance. All we can see is what people are forecasting for demand for this year. And most of the agencies which forecast oil demand are forecasting between 1.2 and 1.6 million barrels a day, which, as I said, is trend demand. So there's no sign of slowing there, in spite of, say, the EV story as well, because that's another big story, right? That it takes away from gasoline or diesel demand. But that's not really happening. You still have decent demand growth for oil.
But still, the prices are not quite perking up, which points towards an imminent slowdown, if not one underway already.
You mean the oil prices?
Yes.
The oil prices haven't picked up because the US has been producing a lot of oil, and the shale production has outperformed most expectations last year. There are new areas which are coming in. Brazil has come back. Guyana has become a significant exporter of oil. So while OPEC cut production, it's been made up by non-OPEC sources, and that's why the oil price is somewhat subdued. It's still $80.
Okay. So you seem to suggest that at least from the business that you are in, which is commodity traffic, there isn't an imminent slowdown from the data points that you scan at. What about the other aspect, which is not a part of your business, but container traffic? You would have some insight into it, not what it means for your business necessarily. How is that looking?
So the container business, as I said, with the caveat that we are not experts on it, except for what we read, is the container ships trade growth had fallen off a little bit. And a lot of the hot market of 2021-22 was driven by disruptions and supply chain snags more than anything else. What has also happened is there's a shortage of car carriers, and there's significant exports happening out of China in the last year. And actually some of those cars are going on container ships. And so that's taking up some container capacity. So these, all of these things happen.
This has never happened before, huh?
No.
Talking about China, we all think it's down and under. There are concerns on that economy. And we've seen that in reflection of what we are seeing on the equity markets. But you did say that demand from iron ore from China is picking up. So give us a sense of what's happening there, because that beast has been quiet for too long now.
Yeah, the demand for commodities, all the tribal commodities, was pretty high. Iron ore grew year on year. Coal grew a lot year on year. Again, but that was due to some weather conditions because hydropower generation was pretty low. So they had to import more coal to make up for the shortage in hydropower generation. So coal imports were pretty high. Bauxite imports were pretty strong last year, year on year. So all of these things don't point necessarily to a slowdown, and we can't see it from what's happening with commodities.
It's only a matter of time, and of course you're a lead indicator on that.
Yeah, we can't see it. We can't see. It's not that they're building up inventories of iron ore, because we can see port inventories as well, and those haven't gone up. So it's going into consumption somewhere. They're exporting some steel as well,
right?
But it's not like they're just importing and keeping it in stock. Right. It's being utilized.
Just trying to think. Sorry, just trying to think where though, because Europe we know is hurting. Hurting. It might not be making its way through the routes that you might be analyzing to other areas. So is it being driven by ASEAN?
Possibly that there is reasonable growth happening in the East, right? In the Eastern economies are still doing reasonable growth, while China, that breakneck growth of 10% for many years together, it's slowing down, but it's still very solid. It's a large economy. Even if it grows at 5-6%, it's a large
base effect, right?
Massive base, right?
Mr. Shivakumar, and I want you to break this down for a lot of our viewers, because we talk about Red Sea, Cape of Good Hope, assuming that everybody listening to us understands what this means, fun for importers. The face of it, you'd imagine your cost of production goes up because raw materials coming in become more expensive, etc. But you transport this stuff. This is good for you, I'd imagine, right? Because people are going to take longer, or they're going to be hiring your tankers for much longer. You also are an ability to charge more if you're going to take longer to sort of deliver the goods. Is this good news for you? Is what I want to understand.
So any disruption has a positive impact for ship owners. When everything is happening absolutely
status quo,
absolutely efficiently. For instance, and let me take you back a couple of years, when Russia was exporting crude oil to Europe, it was going very efficiently because it was a very short voyage. When the war started and you had sanctions and Russia could not export to Europe, they would export it all the way to the east. Now you need a ship for a much longer period, which means you need more ships to just carry the same amount of cargo. And when that happens, the market becomes tighter because the demand for ships has just gone up for the same amount of cargo. So when we talk of demand, it's not just the number of tons you transport, it is ton miles. How many tons into how many miles? Because that tells you how much real capacity you need.
So how much more are you able to charge your customers now?
It's
because
not
you're
just
doing
about,
the Cape of Good Hope.
It's not just about how much you're able to charge. It is the rates have gone up. For instance, Middle East to Europe, we are not necessarily doing that trade. Middle East to Europe carrying refined products, which is a standard trade, carrying diesel, which used to take 22 days going to Northwest Europe, now takes close to 40 days.
Oh, double almost.
Yeah, 38 to 40 days. That freight has gone up 3x, while the time has gone up less. But it's gone up 3x because there's just a shortage of ships. It's more than just a time. Suddenly you need many more ships, and there's a shortage of ships. And therefore the demand-supply balance has just got skewed.
So it doesn't necessarily mean that you're doing better in that sense, right?
It
because
does,
you're at 100% utilization anyway. So
but your utilization goes from, let's say, it was $20,000 a day, suddenly it becomes $60,000 a day. The same ship earns $60,000 a day.
So why is it not reflected in this quarter's earnings?
Because it's only happened now.
So
it's only happened in the end of December.
Okay.
So product tankers have gone up in rates.
So next quarter is going to be basically a bumper quarter for
Some
de-shipping.
of the ships, the product tankers have really have taken off. So they are stronger than they were a year ago. It's mainly the product tanker trade. Which has got affected.
So this is interesting. At a point of time when headlines are talking about recessionary times in certain countries, you are in fact saying that because of the disruptions, etc., Q4 could actually be a really strong quarter for you. Thus far, it is a really strong quarter.
Thus far, it's been stronger than Q3 was for the product tankers. Crude tankers are about the same.
Got it. Yeah. Okay. What is the fly in the ointment, if anything? What could disrupt this party?
So peace.
Yeah.
Well, welcome. I'm sure he'll also welcome.
Yeah, peace is good. But what could disrupt it is actually a worldwide recession, because we haven't, as I said, we are doing business as usual in terms of world trade. If you have actually a drop in oil demand, or a flattening out in oil demand, or a flattening out in dry bulk demand from China, where the recession that people have been forecasting for a long time actually comes, then you would have an issue, because then that actually drops the tons part of the equation, right? So that's something that could be a negative. And you can see the pressures building up, high interest rates, in general inflation, those kind of things.
But just enlighten me. I'm sure you don't look at, when you think of business, it doesn't change at the drop of the dime. You probably foresee what could happen at least 45 days out. So as of now, on Feb 16th, at least 45 days out, there doesn't seem to be any issue for the rates that you're charging.
No, it could change tomorrow morning.
It could.
So we did not know what is going to happen in the Red Sea, which would take.
No, that's
rates
event
up.
specific. But
Which is event specific.
But by and large, the current.
The trigger for a recession will happen with an event. It'll, it's not often that you just drift lower. You could happen either way. But the whole thing is for us, and let me come to us, which is that if the markets go bad, we are okay. We are under leveraged.
Company
and we are terribly under leveraged now. We are net cash. And so we're waiting to buy ships. We just haven't got the right price point. If the market turns bad, we're okay. We are okay. We are happy to buy ships.
Focus G shipping now.
No. So I'm very intrigued. And this is more macro. A global recession and peace is not good for most economies. I think that's my takeaway on a more macro picture.
No, peace will probably be good in the sense that maybe oil prices come off or something like that.
So then, of course, then there is a trickle-down effect on that. But let's talk about your company. I mean, I've heard a few interviews where you've been obviously asked that, you're in a cyclical business. Would you look to hedge yourself? Would you look at investing in other businesses? And I think you and the management has constantly maintained that this is a bread and butter, and we don't know how to operate in stable businesses. Talk to me about the outlook. Talk to me about your vessel utilization, which stands at 100% from what I see. You've also gone on and acquired a product tanker. Tell us what led to that. Any more tankers you're looking to buy? If yes, I'm assuming that keeps in line with the higher demand we are anticipating or may not anticipate.
So we sold one of our oldest ships. Let me just take the last question. We sold a 2004 built product tanker. We're just moving a little bit of modernizing. We have bought a 2010 built product tanker. So we are. So that's part of the modernizing of the fleet. We have a very old ship. We are moving to a more modern ship. That's one thing. We are happy to. So we like this business, and we've run it for 75 years. You're right when you say that we don't know how to run other businesses, and we think we know how to run this business. So we'd like to stick with it. We think we figure out what it takes to succeed in this business at a reasonable level. So we are a cycle player. We buy ships when counter-cyclically, and we hold on to them through good markets. We lever up, we lever down, and that's what we do.
Right. So, Shivakumar, just talk about your earnings while you're with us. Of course, this was reported over a week ago. Your revenues were down, EBITDA was down, margins have also come down. Of course, not substantially, but about 300 bips down. Looking ahead in the next couple of quarters, is this the sort of run rate we should be working with? And also very quickly on your rig business, because I know the revised prices that are doing the rounds are double of what your rates were at, right?
That's right.
What is that repricing going to do for your rig business? And how much does it contribute to your top line? Because so we can understand next quarter what we can expect.
So in the shipping business, 80% plus of our capacity operates in what we call the spot market, which means that if a ship is coming free next week, we will probably find a business for her tomorrow or the day after. We don't know what that rate will be. And therefore, we don't forecast. We have no capability to forecast what our earnings will be for the next quarter. Okay. Because we don't know whether we'll earn $20,000 a day or $10,000 or $30,000 a day. And that's why we don't forecast. On the rig business, yes, the oil field services business is the one bright spot where you can expect more strength than we have currently, because the rigs and the vessels are on old contracts which were at fairly low rates. So rigs were earning less than $40,000 a day on average, our 4 rigs. The recent repricings have happened at $80,000 and $90,000 plus dollars per day. The cost base doesn't change by more than $2,000 to $3,000 a day, which goes to the bottom line, therefore. So the oil field service business, the vessels, which are much smaller in terms of dollars per day, all of them have repriced between 50 and 90% per day in dollars. So the profitability is turning around. The offshore business used to contribute $100 million to our bottom line in 8 years ago. And it came down to zero. and so that can come back at some point if the cycle keeps going up like this.
Right. One last question. It's a pressing one. You keep referring to ships as she. Why is that?
It's a tradition. Ship owners
She's a Lakshmi, is she?
Yeah, that's right. Currently, they are Lakshmi.
So, Shivakumar, great having you in the studio today. Thank you
so
for
much.
taking your time out
Thank
and
you,
talking
Samina.
to us.
Thank
But
you.
I think one thing we know, Niraj, next quarter is a bumper one for G shipping.
That's far so good. If the quarter were to end today, well, you know what the business would have been like. But take a very quick break. Back with Morgan Stanley's Jonathan Garner and why he's bullish on India. Stay tuned. In its Asia Equity Strategy Report released last week, Morgan Stanley said that India continues to be its top pick. We spoke to Jonathan Garner, Chief Asia EM Equity Strategist, and asked him why they picked India over others. Listen in.
Well, I think the first thing to begin with is the very strong domestic growth environment. Nominal GDP growth is running 12 to 15% right now. So just to contextualize that, that's just about the highest in the world. And it's 3 times the nominal growth rate of China. And the Indian stock market is full of domestic demand stocks, which can benefit from that underlying buoyant domestic growth environment. So India has far superior earnings per share growth compared to the rest of emerging markets. So valuations are high on a historic basis, so historic price book of about 4 times and a historic PE of probably mid-20s, depending which index you use. But it's all about that ability to compound earnings per share growth. And the work done by our team in India, led by Ridham Desai, suggests that we're looking at least to 15 to 20% compound EPS growth in rupee terms over the next 3 years or so. So that brings the forward PE multiple down quite considerably. And so, yes, it's true that expensive, India is to some extent expensive versus other emerging markets, but it's never had such strong fundamentals relative to emerging markets as it has now. So we have overweights on 3 sectors, financials, industrials, and consumer discretionary. So all 3 are in that domestic demand grouping that I referred to earlier. So they're direct plays on the underlying buoyant economic environment. And we're more cautious on classic defensive sectors. Well, I can name a stock that's in our focus list, ICICI Bank. So we obviously lean on the work of our domestic team and our domestic banks analysts, and that's the name that we currently prefer. Other mega caps that we have in our list include Reliance Industries. We also have recently added exposure to the real estate sector, which is something we've not historically had exposure to in the form of DLF.
Well, that was Morgan Stanley sharing its view on India, talking to us about how India remains a top pick. Reliance Industries, DLF are some of the counters that they continue to be constructive on. Well, moving on from the macro picture to some news development from yesterday. The RBI has asked one card network to temporarily suspend commercial card-based payments, citing a breach of rules. Pragati is joining us with more on that. Pragati?
Yes, as you rightly mentioned, the RBI has this time come down on the commercial card-based payments, and it has clearly said in its communication last evening that there was one card network in India particularly that was flouting these rules, as it had created a payment system which was not approved by the RBI and was in violation to the rules at present that exist. Now, while RBI has not clarified or given any name as to which card network it was, here is the catch. During the day, that is on Thursday morning, before RBI's clarification or the circular actually came out, Visa, one of the biggest card networks in India and even globally, issued a statement publicly to the media that RBI had communicated to Visa and asked them to halt services by the commercial card payment providers, because RBI also wanted information on the BPS piece. While later in the evening, after RBI's notification, Visa did not issue any statement, there was an assumption that primarily the action might be on Visa. Now, let's look at what RBI exactly found after its investigation. The RBI said that the card network under review created arrangement with intermediaries. These intermediaries would accept card payments from corporates, and all the funds were remitted to non-card accepting accounts. The payment system, which was entirely created with the help of these intermediaries, was in violation to the RBI rules and the rules on KYC. I want to quickly bring to you the Citi's take on RBI's move as well. The firm has said that the RBI wants to ensure end-use liquidity flow during the credit period by bringing this move, and it is likely to have a significant impact on the monthly card spends market in India.
Well, so those are some news and updates, including views from Jonathan Garner. As we wrap up India Market Open today, just trying to see what's moved and what hasn't. And just at the larger end of the market, Rain Industries is the big one, which is now up about 13% at 204. So that, to my mind, stands out as a gainer. The other one has to be Glenmark Pharma. Big move today. Actually, Pharma is not having a bad day, I must say. From a Glenmark to a Netco to a Wockhardt Pharma, the clutch of stocks and Gland, like 4 or 5 names, have done really well for itself. Seems to be an afternoon for pharma stocks. We take a break, or rather wrap up India Market Open. Up next is Talking Point. Entero Healthcare has listed and listed very flat. Remember that there was hardly any. I mean, it was an issue that was subscribed about what 1.5% higher or just about par. There was nothing dramatic in terms of the appetite during the IPO, and the listing therefore looking like or evidently is a subdued listing, flattish performance. Let's see what is in store going ahead for this one. My colleague, in fact, Sajid Mangat, spoke to the Managing Director and CEO Prabhat Agarwal a while back to understand more about the business. He asked him about what is their working capital to sales ratio and how is it that they plan to optimize it. Listen in.
We have a net working capital days of around 60 to 65 days, which includes the the credit that we offer to our customers, the inventory that we keep, and the credit that we receive from our suppliers. So typically we aim to, have a working capital turnover ratio of 6 times to sales. That's how, the business model works. Of course, we are, trying to improve it further, but that's where it stands today. And with growing, our scale, we expect that it will get better in future as well.
6 times sale is a huge ratio that you keep. How do you plan to consolidate this further and streamline it so that it's your working capital reduces?
Yeah, so we want to optimize on inventory levels. Currently our inventory levels are between 30-35 days. We can optimize it further, with our scale going up and with user